Mark Matthews is with us of Bank Julius Baer and Company. Mark, good to have you with us here. Thank you very much for your time. So yesterday was one of those rare days where the market saw a bit of a shakeout. In the US as well, mid-session onwards, there was some pullback. Any particular reasons, Mark, to your mind? And what from here, near term?
Two reasons. The first is that the S&P was up in 8 of the last 9 days, and the Dow was up in 9 of the last 9 days. So you have to take a breather after a run like that. And the second reason is that now people are really starting to go away on holiday in the Western world. The trading is thinning out, the volumes are low, and so you can have things like happened yesterday where I think a lot of traders came in and shorted options on the S&P, driving down shares more than they normally would in if it wasn't a holiday.
Okay, Mark, hi, good morning, and thanks for joining in. So, I think we haven't seen this kind of a sell-off in a long time, right? That's why the little bit of that shock element as well. For people who've perhaps missed out on this rally for a while, do you suggest buying into the dips if it comes through? What does one do? Because there was a little bit of panic that set in yesterday amongst retail investors.
Yes, it's a great time to buy dips. Maybe not today. I think we probably need a couple more down sessions, but I still think we will get that so-called Santa rally, which is from the 25th of December through the end of the year. And if I was to add a fundamental reason for the correction, there have been few Fed officials who've tried to pull back some of the euphoria after Jerome Powell's Q&A last week. And so there was Bostic, who else was there? Barkin, Mester, and Gooseby. They were the Fed presidents of Cleveland, Chicago, and Atlanta, and Richmond. And so they were all saying things like, oh, the dot plot is not something you should take as forward guidance, and this rally is surprising, and inflation is still stubborn, and things like that. But I think the main point is that the cat's out of the bag. I don't think they can take back what Jerome Powell said last week, which was basically that they will start cutting rates next year, and they're not going to wait for 2% inflation. And on inflation, I'd simply say that the personal consumption expenditure index will be coming out soon for November. Now, in October, it was 3.5, and in September, it was 3.7. So it's been coming down, and the Cleveland Federal Reserve, which runs a nowcast of this data series, is looking for 2.99 for November. So 2.92 to be correct. And so if that's true, it will be a further indication that inflation is coming down. And therefore, I don't see Treasury yields rising dramatically, and it all sets us up quite nicely for January.
All right. Hi, Mark. Morning. Mark, but the U.S. markets as well have seen a big run-up. And if you were to fathom a guess with regard to a correction that we could see on the mother market itself, we pulled back just 2% from the peak. What do you think? How deep can we go?
Well, why not 5? I really don't know. I'm just picking a number out of a hat. But I think we could go down another couple of days. And so if you sort of, think along those lines, then I think 5% is a perfectly achievable drawdown, and hardly anything surprising. The average maximum drawdown over the last 40 years, if something around 15% intra-year drawdown. So 5% would be very small. And I think we could probably expect something in that magnitude.
All right. We leave it at that, Mark. Thanks a lot for giving us a quick snapshot of what to expect here on. So not perturbed by the fall that we've seen in the market. I mean, it's barely a pullback as of now. Does it extend itself? Time will tell. But for now, there's no reason to panic. Let's slip into a quick break. On the